Hello, beautiful people, and welcome to another brand new episode of the ITU Forex class. I hope you all had a fantastic week. Today's topic is one that can completely change the way you approach the markets, and it's something I believe every trader needs to understand before they can achieve consistent profitability. We're going to be talking about mechanical trading versus discretionary trading. Now, you may have heard these terms before, but do you really understand what they mean? More importantly, do you know which approach is better suited to your personality and trading goals? Many traders struggle not because they have a bad trading strategy, but because they don't have a consistent way of making trading decisions. One day they follow their rules, and the next day they rely on gut feelings, and before long, they are wondering why their results are all over the place. Okay, so in today's class, I'll explain the differences between mechanical and discretionary trading. We also discuss the pros and cons of each approach and share which one I recommend for traders who want to become consistently profitable. So, if you've ever found yourself second guessing your trades or wondering whether you're making your trading more complicated than it needs to be, then this session is for you. Okay. With that said, let's get started. Okay. So, first things first. What in the world is mechanical trading and what in the world is discretionary trading? Okay. So, basically, mechanical trading, both of these trading approaches, both mechanical and discretionary, they are both methods with which traders use to make decisions within the market, to decide when to buy, when to sell, how much to buy and how much to sell, and all of those decisions that influence your trading performance. Okay, so put simply, a mechanical trading strategy follows a fixed set of rules. Every decision is predefined before entering the market. For example, with a mechanical trading strategy, which trend you trade is defined before you even start finding what trade setups to take in the market. Your trade entry conditions, your stop loss placement, profit target placement, position sizing, trade management, everything is properly documented before you even think about taking a trade. That's why it's called a mechanical trading strategy, because it's basically an if-then kind of scenario. If this happens, then I'll do this. For example, let's say you're using a simple market structure or price action based trend trading strategy, okay, which depends on how should we put it? Which depends on market structure, break and retest. Okay, so in this case, let's assume this market, as you can see, was kind of moving to the upside, or it was kind of stuck in a range. Let's just say it was stuck in a horizontal range. Okay, so price was basically stuck in between this range because it went up, came down, it couldn't break below this support area, went back up, couldn't break above this resistance area, and it just kept bouncing in between these levels of horizontal support and resistance. But then out of the blue, price broke below this support area on the charts, and then after it blew past this support area, it now retested. So assuming you're a break and retest kind of trader, you're a trend trader basically, but you wait for price to break, and then when it retests or make a retracement, you get into the market with the trade in the direction of the trend. In this case, the market was ranging in and around here, and then all of a sudden, when it broke out of this range, we now started moving to the downside. Okay, and then when we started moving to the downside, basically what happened was the trend switched. Okay, so in this case, a proper trend trader will only be looking for an opportunity to short this currency pair, because obviously the market is now trending to the downside. So when we had this break and we had this retracement, okay, when we had this break and we had for a typical pullback trend trader, this kind of this price action we saw here. So let me quickly clean up the charts a little bit and zoom in so that you can see it clearly, and do this and this after we had this break of structure, this break of this support area. Okay, when this break happened and then price was sluggishly moving up here, for a typical pullback trend trader that reads price action, especially candles and all of that, once he started seeing this long wick candles in and around here, okay, in and around this area, and then which got followed by the formation of this big bearish engulfing candlestick, this would have been a cue to take a short trading opportunity with either a tight stop loss if you're using the conservative stop loss approach, or if you're using the if you're using the aggressive stop loss approach, or if you're using the conservative stop loss approach, then your stop loss is going to be placed at a level where if price was to go to that level, then the validity of that trade in and of itself, that particular trade setup, would have been cancelled, would have been nullified. Okay, so what does that mean in practice? So you see this price action that led to this trend that we had here. If you remember, I told you that price was bouncing in between this support and resistance area. Okay, this was what price was doing. It was struggling between this area. So we had our resistance here and we had our support here. Okay, but then out of the blue, price now broke below this support area, and then after it broke below it, we had this pullback. And then I told you, after seeing these rejections and all of that, then followed by the formation of this bearish engulfing candlestick, this would have been our entry for a typical pullback trend trader. Now, if you are using the aggressive stop loss approach, just like I told you, your stop loss would have been placed here. But if you're using the other approach, then where will price go on this chart that will invalidate this setup when you were to look at it? This would be somewhere around here. Why? Because after breaking this low, this would have been our previous most recent high. So if for whatever reason price was to go from all the way down here after triggering our short trade setup, and then it went all the way up here, then we no longer have price forming lower lows and lower highs. Price is no longer forming lower lows and lower highs, and so it's no longer in a downtrend. That would be a nullified trade setup. So we don't want anything to do with that trade setup at that point in time. But like again, with any other thing in trading, there are pros and cons to this approach. If you're using the tight stop loss approach, the aggressive stop loss approach, then your trades are going to get stopped out more often because you are trading with your stop losses being very close to your trade entry. So it's usually going to be easier for price to hit your stop loss and then than it is for it to hit your profit target. But then that is usually compensated for by trading with a high reward to risk ratio. So in this case, for example, if you are taking this setup, let me quickly drop this tool so that I'll make it easy to show it on the chart for you. Assuming you took this short here and your stop loss was somewhere here, you can see because the distance between your entry and your stop loss for this particular example is very tight, you would have easily gone on to take a trade that would give you easily a 1:4, 1:5, or 1 to whatever risk to reward ratio. Okay, again, I'm cherry picking these examples, but I'm showing you both the good and bad sides because I show you trades that also don't work out, because that's to show you the reality of trading. You're not going to win 100% of the trades you take, regardless of which trading strategy you're using. Okay, so this is the first method. But what if you are using the conservative stop loss approach, where your trades are only going to hit their stop loss when price completely invalidates your trade setup? The problem with that approach, not a problem, is actually a con, I would say, not a problem, kind of. But your stop losses are usually going to be very wide. So it's not uncommon for you to take a trade using the conservative stop loss approach in and around here, with your stop loss being above here. But then when you look at it now, for price to reach a 1:2, it's going to take a very, especially if you're trading the higher time frames, it's going to take a very, very long time for price to do that. On the plus side, it's going to be much harder for price to hit your stop loss. And so your win rate is going to be slightly higher than that of the person who is using the aggressive stop loss approach. But win rate is not everything in trading, because somebody can have a very high win rate and then struggle to make a profit, while somebody might have a very low win rate and then make a hell of a lot of money with trading. Okay, so it all boils down to what it is you prefer. In this case, somebody who is trading with the tight stop loss approach, he could take the trade here, and then price would just trigger his setup, then go to hit his stop loss. But then if price is still contained between this area, this range here and here, then technically this downtrending market is still valid. And so if another trade setups within this range, he can still take that trade. And because he's trading with a high reward to risk ratio, he can lose like 3 or 4 trades before one works out and then pays for all of the losses from all those previous losses. Okay, so going back to the topic of discussion, if you're using a mechanical trading approach, before you take this trade setup, your strategy would have properly defined when you enter the market, when you exit the market, how much you risk on the trade you take, how you calculate your position size, and how you manage your trade setups. Everything would have been decided beforehand. On the contrary, if you're using the discretionary trading approach, that involves you making a couple of judgments. Okay, it depends a lot on your trading experience, the screen time you've had with trading and all of that. That's one of the major differences between mechanical trading and discretionary trading. Like the word implies, discretion is when you're using your judgment to decide when to take a trade or when to stay out of the market, how much to risk on the trades you take, how much to aim for as a profit target, where to place your stop. All of those things would be defined based on your discretion. Now, the plus side of this is that it makes your trading flexible, because it's not making everything rigid. Your trading rules, you're not just trading regardless of what the market is saying. You're kind of trading based on a little bit of nuance, and your experience is helping you to shape your trading decisions. But then the con is that, especially for traders who are struggling to become profitable, the major con is that it affects your consistency. Because if you are not profitable and you claim to use a discretionary trading approach, number one, most times is you'd find that person doesn't have a trading strategy that he has backtested and proven that it works. That's number one. And number two, even if that person kind of has a trading strategy that he's backtested, if it's a discretionary trading strategy, the outcome of the trades he took in the past is going to influence his trading decisions. So let me give you an example. Let's say somebody is trading with a discretionary trading strategy, okay? And the past 5 trades he took, for example, all turned out to be losing trades, which in trading is actually not that uncommon. It's nothing, okay? Now, the thing is, if this person doesn't properly understand how probabilities work in trading and all of that, then he might start second guessing when he's going to the trading strategy he's using, and whether or not he should take a trade, when the particular approach he's using might just be working very fine, but then just normal market conditions, the variance in normal markets is affecting his outcomes. And so he might see a perfectly valid setup based on his discretionary trading approach, but then because the outcome of the previous trades he took were all losses, he might decide, okay, you know what, I'm going to skip this trade, only for him to skip the trade and for it to turn out to end up being a winning trade, which would have easily made back all of the profits all of the losses that he took previously. On the flip side, if the past couple of trades this trader took were all winning trades, he might start thinking that, he has cracked the markets, he's invincible and all of that, and before you know it, this guy might, instead of sticking to proper risk management rules, he might get so overconfident that he'll dump his risk management rules and start trading recklessly, and maybe instead of risking 1% of his trading accounts capital per trade, he decides to bet the farm, risk 10%, 50%, or whatever crazy number is out there for him to quickly double his account, triple it, or whatever, because he feels, the market bends to his will now. And the problem with that is that the market will humble you quickly. If you take this type of approach, and let's say, you win a couple of trades, you disregard your trading rules, and then, excuse me, you still end up winning more trades, and you keep doing this bad habit, eventually the market is going to catch up with you. And usually when it does, the loss that you encounter from having such bad behavior is going to be devastating, because it's really going to break, maybe even blow your account, completely. Okay, so if you're not really there, you're not really profitable, and you don't really know the probabilities of trading and how it works and all of that, then I would highly recommend against starting your journey towards becoming a profitable trader using a discretionary trading approach. The reason is because you don't have the mindset, the discipline. The discipline, that's what I was looking for. The discipline to actually stick to what works regardless of the outcomes of the trades you take. So for you to build that discipline, you need to use a proven mechanical trading approach. Because once you've done that and you've used a proven mechanical trading approach, eventually it's going to instill the discipline and the habits of professional trading in you, which will help you eventually when you graduate to trading with discretionary trading strategies or using both of them together. Okay, so moving on. Again, to do a quick recap, a discretionary trader uses experience and judgment to make decisions. Okay, the chart provides information, the trader decides what to do. Example of their thoughts would be something like, this support looks strong, okay? This trend feels weak. I think buyers are exhausted. These aren't fixed rules, okay? They are opinions based on experience, okay? So, the thing with discretionary trading is its characteristics are, like I told you earlier on, it makes your decision making in trading flexible, but it's experience driven, meaning if you don't have time on the charts, okay, if you've just gotten involved, if you're just getting started with trading and you haven't spent time on the chart seeing how price action forms and all of those things, then you have no business doing discretionary trading. Usually you don't have that experience or intuition to kind of, have that gut feel of what price is likely going to do. And add to that the fact that when you're just getting started, you probably don't even know how to think in probabilities. Okay, so that's just going to make your your whole trading journey a lot difficult. Okay, because this is a subjective approach to trading. Okay, and another thing is, it's very, very difficult. It's very hard to test a discretionary trading strategy. So what do I mean? Back testing, again, for the benefit of those who are just joining us and they don't know all of these things. Let me give you an example. Let's say you're trading with a strategy, a simple trading strategy that involves the use of two moving averages. So let me say 150 period moving average. Okay. The periods don't matter. It's just to drive home my point here. Okay. And then we have 200 period moving average. Okay. These are the two of them. So let's say this particular strategy that you use, when the blue moving average, which is the 50 period moving average in this example, crosses below the red one, you're going to take a sell trade because that's showing you that the short-term trend has switched. Okay, so let's say you take a trade here when this switch happened, which is somewhere around here, and then you are not going to exit that trade until the opposite happens, which would be somewhere around here. Okay, now this would have been, let me zoom out a little bit to make it easy for you to see. Okay, taking this trade here, okay, here when the switch happened and closing it somewhere around here, this would have been a profitable trade. Again, you'd have seen this example here. You would have taken a short trade here. Again, this would have been a profitable trade. But in the same vein, you would have taken a long trade here and you'd have exited here with a small loss. Okay, so with this approach, let's say this is your trading strategy, as simple as this. When the blue line crosses above the red one, you buy. And then when the blue line crosses below the red one, you close your buy trade and you sell. Okay, let's say this is your trading strategy. This is going to be very, very easy for you to test, because even within a backtesting software, if you're using one, all you need to do is wait for the blue line to cross below the red. You take the trade, open it and you close it, and that's it. It's easy for you to test. But when you're trading with a discretionary trading strategy that involves your discretion, and let's say maybe you're just trading support and resistance and all of that, then it's going to be difficult for you to test it, because at one point you might decide, okay, this is a resistance area. But then in the heat of the moment, you might say, okay, this wick doesn't look like it has really passed through this resistance, and so this might not be a good resistance for me, or it's not resistance enough. Okay, and then the support too. So because this involves you making decisions on the spot that are based on your experience with price action or the markets or all of that, it's going to make it extremely difficult to have clear-cut rules that are going to tell you when to buy, when to sell, why you're buying, why you're selling, how much risk, and all of that. So discretionary trading strategies, one of their disadvantage is that it's very difficult for you to test. And the problem with that is that when you test a trading strategy that is a mechanical trading strategy, for example, that is objective, you know that you buy when X happens and you sell when Y happens and all of that. When you see the numbers from that trading strategies backtest, that, okay, let's say you've taken 100 trades and you've had a win rate of like 50% and you've made X money, and the losses that you had consecutively were X number of trades, the wins were, when you have ironclad data like that, it does wonders to your trading confidence. Because when you go to trade with that same trading strategy that you have numbers backing its performance in the live markets, when you experience difficult trading situations, it's easy for you to fall back to the trading strategies backtest results to see if what you experienced happened in the past. So, for example, let's say you backtested a mechanical trading strategy that you has proven to be profitable, and then when you went to use it in the live markets to trade, the first couple of trades you took were all losing trades. So let's say you took 5 trades and they all turned out to be losing trades. Now, for somebody who doesn't have numbers backing up that trading strategy, it's easy to panic and start tweaking the strategy or even dump it altogether to start looking for the next best thing. But then for somebody who has the backtest data for that particular trading strategy, it's easy for him to go and look at the data and see, okay, I've just had 5 losing trades in a row. Does this trading strategy in the backtest, is this normal? Is this a normal occurrence? And then when he looks at the backtest, he might see that, okay, during the period which this trading strategy I backtested it, there was a moment where I even took 7 losing trades in a row. In this situation, that's going to quickly make him know that, okay, this losing streak that I'm having, there's nothing wrong with it. It's actually normal. Okay, and so I'm just going to continue trading, and this is not something that is out of the ordinary. But for somebody who is trading with a discretionary trading strategy, having that type of confidence on the go is going to be very difficult, because you don't even have clear-cut rules that decide what you do, when you do it, and how you are doing it. Okay, so again, if you are not profitable yet, if you're just starting trading, if you're struggling to become profitable, I would highly advise you to use mechanical trading approaches to get into the markets first, get profitable, and then eventually, when you're profitable, you could, in that situation, use or add to your trading arsenal a discretionary trading approach, because by then you know the importance of being disciplined, you know the importance of having the right mindset, thinking in probabilities, and all of those groundwork that just going straight into discretionary trading is going to make it extremely difficult for you to develop without the right know-how. Okay, and so this pretty much brings us to the end of this week's episode of the class. But as usual, before we wrap up the class, I'd like to use this opportunity to invite you guys to test out our suite of bots, which are expert advisors, as they are popularly known as, again, trading robots, which are designed to help you look for low risk, high probability trading opportunities, and then place those trades on your behalf, following our risk recommendations to get you start earning while you're learning how to trade. So if you're interested, please reach out to us on any one of our social handles, or feel free to drop a comment in the comment section, and then we'll be more than happy to assist you, set everything up, and get you up and running in no time. In the meantime, thank you very much, and I look forward to seeing you guys in next week's edition of the class. Have a wonderful rest of your week, and God bless you all. Cheers.